Panic, panic, and more panic. The market is panicking, and we need to talk about what's going on in the market and how to prepare for it. This is an important video that will be useful for the rest of 2022 because we're going to talk about what we should do about what's going on in the market, but we also want to talk about why this is happening. We'll talk about why it's also becoming difficult to afford eggs. Yes, literally eggs. They're skyrocketing in price, so much so that a burrito at the local Mexican stand now costs me $14. When I add tip, I'm almost at $20 for a single breakfast burrito. Best burritos in the world, shout out to Corrales, but wow, it's absolutely insane. Okay, look. We got to talk about briefly what happened today because it's somewhat historic, and then we'll actually talk about how what happened today matters for the rest of the year because that's the big deal. So today was just bad, okay? The Dow was down 1,276 points. The S&P was down 4.32%. The NASDAQ was down 5.16%, and you got volatility way up. Every single sector in the stock market today was red. Even Bitcoin was down 7.4%, leading Bloomberg to make fun of a Bitcoin, saying, well, it's clearly not an inflation hedge. And when you hop over here, you see something that you have not actually seen since March of 2020. Every single stock in the NASDAQ 100 was red today. It is the first time that has happened since March of 2020, and that's something that makes today historic. Add insult to injury, you've got the 10-year treasury yield skyrocketing to 3.41%. That's bad for real estate. We're going to talk about that in just a moment. And the 2 years at 3.79, which for those of you paying attention, you might be like, wait a minute. Did you just say the 2-year is higher than the 10-year? Isn't it usually the other way around? Yes. And that's called the inverted yield curve, and it is getting worse, which is a sign that, oh yeah, the recession that is either here or coming, depending on whom you talk to, isn't going anywhere anytime soon. The panic today was also so bad that everybody put the stock market on their front page. We had the New York Times covering it. Of course, we had NPR covering it. There's the Wall Street Journal. And you even had CNN talking about the stock market. And you know what? When CNN is talking about the stock market, it means the stock market's finally more important than Trump bashing. And that is not a political statement. It's just a fact, okay? This was a big sell-off. And the reality is we've got 3.5 months to go, and we're already tracking as one of the worst stock market beginnings ever since the Great Depression for a stock market year. And if you take a look at the records of the NASDAQ falling more than 4% in a day, you could see, look at where we rank in terms of other years. So far, we've had 7 more than 4% declines there, which you could see here on the bottom right over here. And when you compare that to all of these other years, look at the years you're talking about. You're talking about the dot-com bubble, the Great Recession. Notice you have these worst periods of time during recessions. And that's because we're probably in a recession. So, why is this happening? Well, we're going to talk about exactly why this is happening. I do want to give a quick shout out, of course, to all of those of you in the courses on building your wealth. If you want to join those, use the coupon code SEED via the link down below. Excellent courses on step-by-step guides for building your wealth, buying your first home, your first rental, building your wealth in stocks, building your wealth as a real estate agent, YouTuber, or even starting your own property management business. The coupon code for those programs is linked down below. Click that link, use that coupon SEED, and you'll get me in private live streams every day the market is open so I can answer your questions about whatever issues you have, whether it's in real estate or stocks, and you'll get to join me in our fundamental analysis that we do every single morning. This morning, we did some fundamental analysis on the cruise lines. Oh, those are on sale. But are they on sale for a good reason? Well, you have to join the courses to find out. Link down below. Okay, folks, now we got to seriously do a little bit of talking about what happened here today, because the catalyst for all of this disaster today was, of course, the the CPI inflation report. We had expectations that year-over-year inflation was going to come in at 8.1%. That actually came in at 8.3%, which you could see is higher. The month-over-month was expected to come down 0.1%? Nope, actually went up 0.1%. Core was expected to be 0.3%. Nope, actually came in at 0.6. The problem with 0.6 is that works out to 7.2% of an annualized inflation rate. You just multiply it by 12 to get annualized. You do not compound it. Only one German guy got it right out of 64 economists, and it's not so much, folks, that the inflation rates fell, but just missed expectations. That's not the biggest problem that we had here. Yes, look, inflation this summer hit a big peak. We were over 9%. Leave a comment down below if you watched me live on a beach in Germany doing the CPI report live from my phone going, oh my gosh, it's over 9%. This is insane. Okay, leave a comment if you were there for that. But folks, okay, this is a problem, not because, yeah, inflation is like hitting a new high, but because, first of all, the speed at which it's falling is slower than the expectations, but worse, everything is still going up. Sure, rent and shelter went up 0.7%. Really, really high. That has like a 33% weight of inflation. That means it's getting more expensive as rents go up to rent properties. And so what happens? Well, we get more inflation. More inflation means the Fed has to be more aggressive to us and push the stock market down as a consequence of this. They're trying to do this on purpose because the less wealth we have, the less rich we feel. And when we feel less rich, we spend less money. And when we spend less money, potentially then inflation can actually really come down. But this isn't just a matter of rent being up 0.7% on the month or used autos not falling as much as we thought they would. It's the fact that everything is going up. In fact, we can take a look at all of the different categories right here. Take a look at the different categories. We've got trimmed mean, median, sticky prices, excluding food and fuel, so core, services, and unfortunately when you plot these, all of the trajectories for these levels of inflation are up. They're actually not peaking. On top of that, and this is bad, if you just exclude like all of those major categories that I talk about, and this is the bottom line you want to know about this, okay? If you take out shelter, you take out food, you take out energy, so you take out those expensive eggs, you take out rent, you take out cars and trucks, you take all of that out, and let me show you what you're left with, okay? Because the purpose of this is try to understand, well, what's everything else doing, right? Like, how about medical bills? How about window drapes? How about carpet for your house, right? How much are those going up? Well, if we just look at that chart, folks, it ain't any better. Inflation, excluding everything, is still rising a lot, okay? Over 6%, it's still going up. It's absolutely bonkers. It's not just gas, it's not just shelter, it's everything. Okay, eggs were literally up 2.9% this month. If you annualize that, that's a 34.8% increase for eggs, okay? That's wild. And so we've got this really big issue, and that is that inflation is proving to be sticky. And when inflation is sticky, the Fed has to take out its hammer and hammer inflation down. It's kind of like whack-a-mole. And the more the mole keeps coming up, the harder they have to hit to get the mole back in the hole. Problem is, once the mole's out of the hole, it's really hard to get the mole back in the hole. So, what's likely to happen now? Well, the Fed is likely to increase interest rates even more substantially than we were pricing in just yesterday. Just yesterday, we had about a 60% chance that we were only going to get a 50 basis point interest rate hike. That's about 0.5%. That means the Fed was only going to make interest rates about 0.5% more expensive because the Fed usually does what the market is predicting the Fed is going to do. Kind of interesting. It's almost like the Fed doesn't have to do anything other than come out and talk to us about how they're going to fight inflation. Then the market prices in what the Fed's going to do, and then the market or the Fed looks and goes, "Oh, okay, you guys think with an overwhelming majority we're going to raise rates by 75 basis points this meeting? Okay, that's what we'll do." That's pretty much how they operate. They kind of guide us verbally. We price it in, and then they actually do it. And so this is very neat because that allows us to go over and look at the Fed rate probabilities. And right now, the federal funds rate, I call it the F rate because it's like, oh, F, it's going up again. Right now, we're sitting at 2.5%. That's the upper range, so we're technically 2.25 all the way up to 2.5, right? That's the range for this rate. Don't worry so much about the range, but it's important for you to know because when you look at this right here, you can see that right now we are pricing in a 65% chance of having a 75 basis point hike. But we're also, which we were not pricing in last time, we are now also pricing in a 35% chance of a mega jumbo 100 basis point hike. That is a full percent. So the F rate could go up a full 1%. And last meeting, Jerome Powell told us, hey, it's not going to be typical for us to have large rate hikes, don't worry. And at this point, you should kind of know that if the Fed says they're not going to do something, they're probably going to do it. Because they told us inflation was transitory, they were wrong about that, at least thus far. Maybe one day they'll prove to be right. They told us, oh, hey, we don't expect to have to do these outsized hikes much more, or more than, the occasional instance. Well, now we're about to get another 75 basis point hike following the other two that we've had. And this is because markets are screaming at the Fed saying, hey, you need to get inflation down and y'all are too late to the party to whack that mole back in the hole, so you have to be a little bit more aggressive. Unfortunately, it's this aggressiveness that makes people nervous, and it also makes markets nervous, and they want to sell and get out of the market, especially real estate, which we'll talk about in a moment, not only because rates are going up, which makes things more expensive, but also the fear that this is potentially just the beginning, that rates might actually have to go up even higher than ever previously thought. And the reason for that goes back to the 1970s. See, in the 1970s, we had really high inflation because we left the gold standard, which meant the dollar was no longer backed by gold. That created some initial fear, which was then made worse by three other things. We had a war, the Vietnam War, we had an oil shock, and we had high inflation expectations, which is when people think that inflation is going to go up. And generally, when people think that inflation is going to go up, it tends to be self-fulfilling. That's because people rush to the store and go buy stuff before it gets more expensive. So you kind of get that last push of inflation that way. You had all that in the 70s. And as a result of those 70s, we ended up getting what was called Paul Volcker. That's because the then chairperson of the Fed raised interest rates higher than the level of inflation. In order to do that today, the Fed would have to take that F rate from where it is now, 2.5%, and forget about a 1% interest rate hike. They would have to go from 2.5% to like 9% to really crush inflation. And the reason they'll do that, if they need to, is because if you don't rein in inflation, you could completely collapse the economy and lose your currency. It's what happened to Germany with wheelbarrows of cash in the Weimar Republic. The entire economy just collapses. The currency evaporates. It's happened in Venezuela. It's happened in Zimbabwe. And we're no exception. It could happen to us as well. That's why fighting inflation is much more important than, hate to say it, but people's jobs, because they could get laid off, and that tends to be a consequence of all this, or being in a recession. And we have a lot of similarities today as the 70s. We have an oil shock. We have a war, Russia, Ukraine, right? The threat of China, Taiwan. Now, there is a little bit of a difference in that we didn't just leave the gold standard. We didn't just have a bunch of expirations of price caps and ceilings from the administration at the time, but there is a bit of a difference. Today, inflation expectations are lower. And so this is leading some people to say, like, okay, well, maybe the Fed doesn't have to Paul Volcker us. But unfortunately, today's inflation report is just something that says, no, you guys got to be a little bit more serious than you're being right now because it's taking too long. Problem with the Fed and problem for the Fed is the tools that they use, raising rates, act slowly. It takes time for those to take effect. So what are some people saying? Well, you get people like Larry Summers, the former Treasury Secretary, who says, you know what? It is time for a 100 basis point hike to reinforce your credibility. Because as soon as the Fed loses credibility, then unfortunately all of their words of trying to coax the market down won't work anymore. People just won't trust the Fed, and that could actually lead inflation to skyrocket, actually, and then we really have a bad market to look forward to. So, Raising the F rate is going to happen. It's going to go up. There's some debate about whether it's going to go up by 75 basis points. There is even a fund manager who's arguing, hey, you know what? It should only go up by 25%. It's this guy named Gunlock, and he says, we should only go up by 25 basis points because otherwise the Fed's going to overdo it. Unfortunately, the Fed tends to do what the market wants to do, or what the market wants it to do, which right now has a 65% chance of a 75 BP hike. It's what we're going to get. So the market's saying, hey, Fed, you're going to have to give it to us dirty. And what's this going to do? It's going to hurt stocks, and it's going to hurt real estate. Now, what do we have so far? Well, we had a lot of pain in the stock market today. We know it's because inflation isn't just going up. We didn't just miss expectations, but it's everything is getting more expensive. It's broad and widespread, really bad. We also know that the markets, when the Fed hikes rates, think, we have to price in a recession. And that means stocks go down, and as rates go up, real estate gets hurt as well. We've already seen real estate start getting hurt. In fact, we've already seen real estate fall to the tune of 5.5% in just 5 months. And that's really bad because it brings back memories to 2009, which is the last time the housing market fell more than 1% per month. Now, 1% per month might sound like not that much, especially when you compare it to the stock market that just fell like 5% as the NASDAQ, right? But 1% per month in real estate is bad because real estate moves slowly. And I'm going to show you why it could be even more dirty at the beginning of next year. Now, this is really, really important. So you're going to want to understand this because there are a lot of people today who still argue, what are you talking about? Real estate's fine. Year-over-year prices are higher. It's so exhausting. Obviously, they haven't taken the courses on building your wealth. Link down below to understand what's happening. But now I'm going to teach it to you. Okay? Here. See August on the left side, August 2020-21? See how that point is actually lower than where I labeled August 2022? Yeah, over here is higher than over here. So when you compare, you actually still have a positive. Maybe it's positive 5% or 4% or 8%, whatever, right? But wait a minute, where are we trajectory-wise? Oh, crap, that's where we are. So right now, the trajectory of real estate prices is down, and that's the problem. It's probably because purchasing power has been evaporated to the tune of about 35% because mortgage rates have skyrocketed since December, and guess what? They're still going up. It's really, really bad. All of that is going to lead home prices to fall more. And next year, I would guess somewhere around March, when we look back to where that falling started, we're probably going to see negative home reports, price reports. We'll literally have Tucker Carlson and CNBC and CNN, whatever, going on TV going, home prices year over year down. And that could potentially lead to fear selling by sellers. We haven't seen that yet, but we also haven't seen those year over year declines yet. So just wait, get ready for that. If you're not part of the real estate investing courses yet, link down below, and you're intimidated by real estate, I kid you not, there's probably no better time to enroll and study for real estate by following those lectures in the links down below and watching me do fundamental analysis live with you than now. Like, now's the time to learn because you want to be ready to go in 2023 and 2024. It's actually why I'm starting this company. HouseHack. This company, HouseHack, is literally going to go out there and buy homes in 2023 and 2024 because I think it's going to be a beautiful time to buy real estate. In the meantime, though, consumers are going to see their wealth likely to continue to decline. We're probably going to see payroll numbers plummet, which means we're going to see more joblessness and, unfortunately, a higher payroll report, or a higher unemployment report, I should say. And even though today banks like Capital One tell us that consumers are still in a relatively strong position, that they have more savings than they did before the pandemic, and that bank balances are starting to increase a little bit, we don't know how long it's going to be until all of this decays. And when it decays, that is, when consumers actually start weakening because they start losing their jobs or whatever, well, folks, we might enter what's known as phase 2 of the bear market. This is a Goldman Sachs piece here. They say that phase 1 of the bear market is complete, and now it's time to potentially go into phase 2 of the bear market. Phase 2 of the bear market is when you go into what's known as an earnings recession. So far, we've already seen companies downgraded like crazy over the last 2 months. The green bars represent downgrades to company estimates for earnings. And when you couple those revisions to the downside, plus more negative revisions coming from analysts, which we're seeing on this particular chart right here, compounded with the potential consumer weakness coming as consumer wealth goes down, oh boy, we could be in a painful, painful market, quite frankly, not just for the rest of the year, but for the next year. I hate to say it. Now, I'm going to give some ideas and suggestions in just a moment, but this is bad. Again, snapshot where we are. Really broad inflation. Fed has potentially this position of, well, our efforts take time, but then the markets are like, Fed, you suck. You need to restore your credibility and talk tough to the market and push this market down. And that's exactly what's happening. That's why we had a sell-off today. And you have a sell-off because we're potentially going to go into an earnings recession. And it's a problem. So, what would I do now in this position? Especially since there are quite a few things that could happen in the market that won't be so beautiful. Well, here's what I would do now. And I want to be very clear about this. Even though I'm working on becoming a licensed financial advisor, I've already passed my test. I just have to file some paperwork, which has already been filed. Once that paperwork is cleared, then I'm officially a licensed financial advisor. Even though I will be that, I cannot provide you financial advice in this video because I cannot give you non-personal financial advice. I just want you to know from somebody with a finance background who loves doing this for a living, these are some of the things that I would consider. The very first thing that I would consider is there are 2 things that could happen in stocks, and you need to know the 2 things that could happen in stocks. Number 1, we could revisit 1982. And you could see the stock market skyrocket something like 20% in a very short period of time. That is entirely possible. Then you could, number 2, potentially see, and this is the second option, which isn't as great, the following. You could see stocks suffering for 14 years like they did after the tech bubble. That would be an issue, okay? So it's important to go in knowing that. Very, very, very important. Because when you go in knowing that, you're Gucci. Because now you know what you could potentially face. You could go to the moon, or you could just have hell for the next decade, okay? So, now, what do I believe that you should practically do? And again, not financial advice for you, but practically, number 1, best time to start a business is in this environment. I started my real estate business the bottom of the last real estate cycle. That was painful. It was really hard to start, but it made it really easy to make money in 2013 to 2019 as an agent because that was boom time and it was freaking awesome. Starting was really, really hard, but it set the stage. It set a really good, strong foundation for strength going forward. Second, I believe that getting into real estate, or at least preparing, courses or not, is brilliant. The issue here is timing. There's gonna take more time for the real estate market to actually get to bottom before it starts trending up again. It could take years, so you wanna be prepared here. Now, I don't believe the time to buy real estate is right now, because I still think there's more pain ahead of us, okay? I wanna be very clear about that. The next thing that I would do in terms of also preparing to get into real estate is start paying down debt. Get educated, consider becoming a real estate agent, not a bad idea as well. It's kind of combining option 1 and 2, and get your income up. You want 2 years of W-2s and work experience and tax returns so you could qualify for real estate. Now's the time to get your credit up. Now is the time to get your W-2s in order. Now is the time to get your debt down. All of that's going to help you buy. Third, dollar cost average into stocks that you believe in only for the long term if you're willing to ride either scenario, which means we go to the moon up 20, 30, 40%, double, triple, whatever possible, or we trade sideways painfully for 14 years. I don't think either of those are really, really likely. Personally, I think we're probably going to bounce along the bottom until we consistently see inflation go down, and that could take another 4 to 12 months. And then maybe we'll get some form of recovery, but every recession and crash is different. So if we have an earnings recession, stocks are probably going to move down even more. So potentially look for companies that would be less affected by an earnings recession, which would be companies that are still growing through a recession, potentially like Tesla. Fourth, consider getting licenses. Become a white-collar worker instead of a blue-collar worker when you can. Up-level yourself, increase your income, and stay strong. What am I personally doing? Personally, I'm taking the dollar cost average into stocks approach. That's because I believe anytime the NASDAQ is sitting between 280 and about 320, the market's kind of just bouncing along bottom. I really don't think we can go lower than that trading range unless we get inflation that comes in way higher than what we saw this summer, which was a 9% read. Are we going to fluctuate a lot and very violently between that trading level? Absolutely. In the meantime, I'm also getting ready to go shopping for real estate. Thanks so much for watching, and good luck.